Welcome back to Stock Spotlight. I'm your host, Michael. Episode 28 is a deep dive into insurance brokers, one of the most consistent yet overlooked compounding sectors in financials. On the surface, these companies can look very similar, but when you dig in, the differences in execution, growth, valuation, and capital allocation are what actually drive returns. So today, I'm going to break down why these are often hidden compounders, how the business model really works, and how the market is pricing each name across AON, AJG, BRO, MRSH, and WTW. We'll start with my quality scores, then walk through the brokerage model before getting into growth, cycles, and M&A. From there, we'll cover fundamentals and valuation, and wrap up with what each company actually offers depending on what kind of investor you are. Let's begin. I'll start by anchoring this with my 33-question checklist, which helps frame how I assess baseline quality across the group. AON scores 55%, which put it in the 34th percentile overall and the 27th percentile within its sector. AJG scored a 33%, which put it in just the 4th percentile overall and the 5th percentile within the sector. BRO scored a 48%, which put it in the 21st percentile overall and the 9th percentile within the sector. MRSH scored a 79%, which put it in the 90th percentile overall and the 100th percentile within the sector. And WTW scored a 48%, which also put it in the 21st percentile overall and the 9th percentile within the sector. MRSH screens the strongest on a fundamental checklist basis, while AJG screened the weakest. A big part of that gap, I think, comes from what the checklist rewards versus how these businesses compound. The framework favors balance sheet strength, efficiency, and consistency, while AJG and BRO lean more heavily on M&A-driven growth and capital deployment, which can suppress scores but still drive strong shareholder returns. Let's now turn our attention to how the insurance brokerage business model works. At a high level, insurance brokerage is a very unusual business model. Brokers do not actually set the price of insurance. That is done by the carriers. And just as importantly, customers are typically not shopping around for the cheapest broker. They are shopping for coverage and for carriers, not for who the broker is. That dynamic removes a lot of the traditional price competition that you see in other industries. What brokers really do is influence decisions. They help clients figure out what coverage they need, which carrier is the best fit, and how to structure the policy. In many cases, the client does not really care which carrier they end up with, as long as that carrier is reputable and pays claims. That gives brokers a lot of influence in the decision-making process. When you compare this to insurance carriers, the difference becomes clear. Carriers are capital-intensive businesses. They are exposed to underwriting risk, pricing cycles, and loss volatility. Brokers, on the other hand, are asset-light, relationship-driven, and highly scalable. Over time, more of the economic value in the system tends to accrue to the broker rather than the carrier. From a revenue standpoint, the model is relatively simple. Brokers earn commissions, which are typically a percentage of premiums, and they also earn fees, especially in more complex or enterprise accounts. There's an important nuance here. In the SME or small and mid-sized business segment, revenue is more commission-based, which means brokers benefit directly when premiums rise. In larger enterprise accounts, the model shifts more towards fees, which makes revenue more stable, but also less directly tied to premium inflation. Over time, the real power of the model comes from retention and expansion. Brokers keep clients for long periods, they cross-sell additional services, and they expand relationships. That leads to increasing lifetime value per client, which is a key driver of long-term compounding. Now that the model is clear, the next step is to separate what is structural from what is cyclical. Insurance premiums grow over time, largely tracking economic growth, inflation, and rising insured asset values. You can see this clearly in U.S. data. According to the U.S. Treasury's Federal Insurance Office, total direct premiums written across life, health, and property and casualty insurance have grown from roughly $1.3 trillion in 2015 to over $2.1 trillion by 2024, which is a 5.5% CAGR. And over that time, North America has remained the largest share of the global P&C market at roughly 45 to 50%, while emerging markets, particularly in Asia and China, have steadily increased their share. Developed Europe has been more stable to slightly declining as a percentage of the mix. At a global level, research from the Swiss RE Institute helps explain why. Their research generally points to low single-digit real premium growth over the long term, which translates into mid-single-digit nominal growth when you include inflation. So structurally, even before market cycles or M&A, brokers are tied to a premium base that is steadily compounding. And because brokers are often paid as a percentage of the premiums, that creates a built-in growth engine. In many cases, if premiums are growing in the mid-single-digit range structurally, broker revenue can grow in line with that even without adding new clients. Now, layering in the most recent data helps frame where we are in the cycle today. According to recent reporting from Carrier Management in February 26 on the 2025 insurer results, net premiums grew about 5% in Q4 25 year over year. Full year 2025 premium growth was closer to around 8%, and the average combined ratio improved to roughly 89 in 2025, down from 91 in 2024. So what that tells you is growth remains solid, but is below the unusually strong levels seen post-COVID in that 2021 plus time period. And then at the same time, underwriting profitability has improved meaningfully. That combination, still healthy growth with improving profitability, is consistent with a more mature phase of the cycle. It is also worth understanding where those premiums sit. Using data from a recent insurance business P&C market analysis, auto represents around 42% of premiums, property is about 36%, liability is around 20%, and then everything else is really small, roughly 1 to 2% each. Auto has consistently been the anchor of the market, staying above 40% of total premiums for over a decade. But one of the more interesting shifts is happening in property. Property's share has increased from about 31% in 2019 to 36% in 2024, driven by higher insured values and catastrophe-related pricing. At the same time, liability has declined as a percentage of the market, falling from roughly 25% historically to under 20% today. Now layering in combined ratio adds another important dimension. The combined ratio measures claims and expenses as a percentage of premiums, so the lower is better. A ratio below 100% means the insurer is underwriting profitably before investment income. Auto combined ratios improved to around 82% in 2024. Property was even better at around 77% in 2024, down from roughly 85% in 2022. You can break the combined ratio into two components: the loss ratio, which reflects claims paid, and the expense ratio, which reflects operating costs. Property tends to have lower loss ratios in good years, but higher expense ratios and greater overall volatility depending on catastrophe activity. Liability, on the other hand, runs with higher expense ratios and more stable but less attractive margins. Specialty lines tend to be the most profitable with low loss ratios and relatively efficient cost structures, though they are a much smaller part of the overall market. So what this tells me is that both auto and property are underwriting profitable today. Property is currently more profitable, but it's also more volatile with profitability swinging based on catastrophe cycles. And that auto is relatively more stable with fewer extreme underwriting swings and improving discipline over time. That profitability dynamic ultimately feeds back into pricing cycles, which is where brokers make their money. On top of that structural growth, the industry moves through cycles. In a hard market, carrier capital is constrained, premiums rise, while pricing can increase 5 to 10% plus, sometimes even higher depending on the line. Whereas in a soft market, capital is abundant, competition increases, and premium growth slows or flattens. But what's great is that even in softer periods, retention typically remains high and the model continues compounding. There is one additional factor to keep in mind. Brokers temporarily hold premiums before remitting them to carriers, earning interest on that float. That creates a tailwind when short-term interest rates are high and a headwind when interest rates fall. And it also tends to be more meaningful for larger, globally scaled brokers like AON or MRSH. At a high level, these companies all operate in the same industry, but their exposure to the insurance cycle and how they generate growth is very different. You can actually see that directly in the segment mix. AON generates roughly a third of its revenue from human capital and consulting, which makes it less directly tied to P&C pricing and more focused on monetizing complexity through data and advisory. Marsh, or MRSH, is perhaps the most directly levered. Its core business combines large commercial brokerage with a leading reinsurance franchise, which are the most pricing-sensitive parts of the insurance market. AJG is more middle market. It benefits broadly from pricing increases flowing through commissions, while its risk management segment adds that recurring revenue to help smooth performance. Brown & Brown, or BRO, is also middle market, but with more exposure to affluent clients and specialty distribution. That makes it more relationship-driven and less dependent on large property placements. And then WTW takes a different approach. It is more balanced across benefits and commercial risk and is leaning into specialization, building expertise in areas like cyber and complex risk to sustain pricing power even as rates soften. So the key divide is really exposure. MRSH is the most levered to property and reinsurance cycles within brokerage, though about a third of the business is still consulting. AJG and BRO capture pricing through distribution, and AON and WTW are also more diversified, with WTW specifically betting on specialization over scale. And that positioning is what ultimately drives how each broker performs as the cycle evolves. Now, there is one more core growth engine to discuss, and that is M&A. And that is because it is not a nice to have here. It is a core part of the insurance brokerage business model, especially for names like AJG and BRO. The tax structure makes that even more important. Most brokerage deals are structured as asset purchases, which allows the buyer to amortize intangible assets over roughly 15 years. That creates a real tax shield and boosts post-tax cash flow. But that is not free value. The buyer pays real cash up front, and the tax shield runs off over time. So if M&A slows, free cash flow can look less durable than it did during the roll-up phase, because a portion of that cash flow was effectively being supported by ongoing deal activity and fresh amortization from new acquisitions. With that context, let's step back and look at how the market has actually rewarded or punished these businesses over time. In my long-term total return charts pulled from stock analysis with data through April 14th, the group has not moved in lockstep. Over the max period in my chart, which goes back to June 2001, BRO has delivered the highest total returns at 1,597%. AJG is next at around 1,513%. AON follows with 1,197%. Then it's WTW at 989% and SPY at 761%. And then lastly, MRSH at 482%. That means all but MRSH have outperformed SPY over the long run. More recently, that picture looks very different. In my current return table, year-to-date performance is negative across the group, while SPY has held on to a year-to-date of a plus about 1.6%. BRO is down the most at 15.24%, which AJG then follows at 13.82%, and then it's WTW down 11.81%, AON is down 8.3%, and MRSH is down the lowest at 5.49%. So these are all high-quality businesses, but they're absolutely not immune to short-term compression. Looking at their market behavior, the beta data I pulled from stock analysis adds another layer. WTW sits around 0.63, AJG around 0.68, MRSH around 0.75, and AON and BRO around 0.83. And then I actually pulled BWIN, which has the highest beta at 1.27. Most of the large brokers sit below 1.0, which does support the idea that this is a relatively defensive group. BWIN stands out as a high beta outlier. It is not part of this episode, but it screens very differently on both beta and valuation and is worth flagging as a potential follow-up name for further research. Correlations from my portfolio visualizer table tell a similar story. Long-term correlation to SPY ranges from a low of 0.42, which is BRO, to a high of 0.58, which is MRSH. And peer-to-peer correlations mostly sit between a low of 0.44, which is between MRSH and WTW, and a high of 0.63, which is AJG and BRO. So these businesses clearly share industry exposure, but they are not interchangeable. Company-specific factors still drive a lot of the dispersion. Turning our attention to fundamentals and valuation, let's start with revenue and scale. This is a structurally growing industry, and you can see that clearly across all 5 brokers over the last 10 years. MRSH and AON operate at the highest absolute scale, reflecting their global footprint and large enterprise client base. WTW and BRO are similar in absolute terms, while AJG sits in between both ends of the spectrum. When you shift from scale to stability, the dispersion across the group becomes much more interesting. On revenue stability, MRSH and BRO screen the strongest at around 60, while WTW trails meaningfully at about 36. However, on organic growth stability, the range is tighter overall, with all names falling between roughly 50 and 70. But the ordering flips. WTW screens the highest now at about 66, while BRO comes in the lowest at around 56. Then on to free cash flow stability, the dispersion widens again. BRO stands out by a wide margin at about 58, while AON trails at roughly 18. So depending on which layer of stability you care about, the ranking of the group actually changes quite a bit. These stability scores are based on a 10-year risk-adjusted consistency formula that rewards higher average performance while penalizing volatility and deeper trough years. So a higher score means the metric has not just been steadier, but also more resilient over time. If you isolate organic growth, the picture becomes clearer. The group tends to cluster in the mid-single-digit range over time, with some cyclicality around pricing conditions. That reinforces the idea that underlying growth is steady, but not high growth, and that headline revenue can sometimes overstate the durability of that growth when M&A is a major contributor. Looking at profitability, EBITDA scale also matters. MRSH dominates the group at about $7.8 billion of EBITDA in 2025, followed by AON at $5.7 billion, AJG at about $3.5 billion, WTW at $2.7 billion, and BRO at $2 billion. But scale is not the full story because the margins differ too. Looking at SBC adjusted free cash flow margins, BRO has been consistently the highest over the last decade, with AJG and AON getting above BRO a few times. As of 2025, BRO is at 21.8%, MRSH was second at 17.1%, followed by AON at 16.2%, WTW at 14.3%, and AJG, the trailer, at 12.2%. But note, even that 12.2% is still a pretty good free cash flow margin after stock-based compensation. But if you care about current cash generation quality, BRO definitely stands out from the pack. Then you get to cash deployment. I created a metric for this episode called cash deployment ratio, which is defined as acquisitions plus CapEx divided by operating cash flow. The higher the ratio, the more aggressively a company is reinvesting its cash back into the business. Looking across the group, AJG stands out as the most aggressive capital allocator. The ratio spikes meaningfully in multiple years, including a very large step up in 2025, reflecting its continued reliance on M&A as a core growth driver. BRO also leans heavily into acquisitions, but in a more consistent and scaled way over time. MRSH is more selective, with deployment spiking in certain years, but generally running at a lower and more controlled level. AON shows a similar pattern, with more episodic deployment tied to larger transactions, rather than a continuous roll-up strategy. WTW is the least acquisitive of the group, with high deployment earlier in the period, but a clear step down over time, which reflects that shift toward organic growth and specialization. So the key takeaway is that while all five generate strong cash flow, how they deploy that cash varies significantly, from highly acquisitive models like AJG and BRO to more selective or internally focused strategies at AON, MRSH, and WTW. The balance sheet is another area where the group starts to separate. On interest coverage, WTW and MRSH screen the strongest, currently at roughly 8.6x and 7.2x respectively, followed by AON at about 5.8x and BRO at 5.5x, with AJG trailing at around 3.8x. Over the past decade, MRSH has been the most consistently strong here, while WTW shows the most volatility. Looking at leverage, the same pattern broadly holds, but with more volatility year to year. Net debt to EBITDA is currently lowest at WTW at about 1.4x, though notably it was one of the highest in the group the prior year, highlighting how dynamic its balance sheet has been. MRSH and AON have generally operated in a more stable, mid-2x range over time, while BRO and AJG have consistently run higher, reflecting their more acquisition-heavy models. Debt to free cash flow tells a similar story. MRSH and WTW screen is more conservative over time, while AJG and BRO tend to run with higher leverage relative to cash generation. Finally, forward growth expectations, which is mostly 2026 to 2028, although some companies do have 2029 and 2030, will help us frame how the market is underwriting each of these businesses. On the revenue side, expectations range from about 9.5% for AJG at the high end to MRSH at the low end, 3.3%. Note these are CAGRs. On the earnings side, that spread widens further. EPS growth is expected to be about 17% for AJG, 13 or 14% for WTW, 10% for AON, about 9% for BRO, and about 8 to 9% for MRSH. So what you see here is a pretty clear separation in how the group is positioned. AJG screens as the highest growth story, driven by that acquisition model. WTW also screens well on forward EPS, which aligns with its shift toward higher margin, more specialized businesses. And then at the other end, Marsh comes through as the lowest expected growth name, which is consistent with its scale and positioning. So stepping back, depending on what you prioritize, growth versus stability versus capital allocation, the identity of the best business in the group can look very different. Now, turning to valuation, my full year 25 organic growth versus next 12-month EV to EBITDA chart is probably the most useful visual in the whole deck. At a high level, AON is at about 6% organic growth and trades at around a 13.3x multiple. AJG is also at 6% with a 12.7x multiple. MRSH is 4% growth at a 12.4x multiple. BRO finished 2025 at 2.8% growth and trades at 11.9x multiple. WTW was at around 5% and is at a 10.5x multiple. So the first takeaway is that AON and AJG clearly sit at the top of the valuation range, even though their growth is not dramatically higher than peers. At the other end, WTW screens as perhaps the most discounted, while BRO also starts to stand out as an interesting value case here, trading below the group despite a long track record of strong execution. Free cash flow adds the next layer. On a current free cash flow yield basis, AJG is at around 3.2%, AON is at 4.7%, BRO is at 6.1%, MRSH is at 6%, and WTW is at 5.7%. So again, you see a clear split here. AJG and AON are the most expensive on a cash basis, while MRSH and BRO screen as the most attractive on yield, with WTW sitting in between. So when you put it all together, the market is pricing three different buckets. AON and AJG can perhaps go in the premium section. MRSH is sort of in the balanced. And BRO and WTW, and then also perhaps BWIN, which you'll see on the PowerPoint slide, are value or re-rating candidates. With the framework in place, the recent news flow makes more sense. In early 2026, the group sold off on headlines around a new ChatGPT insurance app. The concern was straightforward. If insurance becomes easier to quote and bind digitally, maybe the broker gets cut out. But the reality is more nuanced. Commercial insurance is not a simple checkout flow. It involves structuring risk, negotiating with carriers, managing claims, and providing ongoing advisory. That creates real switching costs and makes the model far more relationship-driven than transactional. That view is reinforced by industry commentary. For example, Morningstar noted that commercial clients are likely to adopt AI tools slowly, given the need for reliability and trust over time. And when you look at company strategy, the messaging is consistent across the group. AON is leaning into its integrated platform to drive cross-sell and retention. MRSH is focused on margin expansion and platform simplification. AJG and BRO continue to execute their M&A-driven compounding strategies. And WTW is working on reshaping their portfolio, plus margin expansion driven by mix and operating leverage. Rather than forcing a single winner, the more useful way to think about this group is by what each company actually offers as an investment. AJG is the clearest M&A-driven compounder. It delivers the strongest forward growth profile in the group, driven by a consistent acquisition engine. The trade-off is higher valuation, lower current free cash flow yield, and more reliance on leverage and integration execution. AON is the cleanest operating model. It combines strong organic growth, high margins, and less dependence on acquisitions to drive results. That consistency also shows up in the multiple with less room for error. BRO, or Brown & Brown, is the strongest cash flow story. It leads on free cash flow margins and long-term compounding, and screens as an interesting value case today. The trade-off is slower near-term organic growth and continued reliance on acquisitions. MRSH, or Marsh and McLennan, is the scale and quality leader. It combines the highest EBITDA base, the strongest checklist score, and a solid balance sheet and cash yield metrics. The trade-off is lower expected growth and less pure exposure to brokerage economics. WTW is the lower beta hybrid. It screens cheaper on EV to EBITDA, has solid forward EPS growth, and a more conservative balance sheet. But the model itself is less clean, with more advisory exposure and less direct comparability to peers. And then we've got BWIN, which is the high growth outlier. It screens with the highest growth and beta, but does not receive a premium multiple, suggesting that the market is still discounting durability. That makes it a potential follow-up idea. So the right takeaway is not a single best stock, but a set of trade-offs. AJG and AON for premium growth and quality, MRSH for scale and consistency, BRO and WTW for relative value, and BWIN as a higher risk growth outlier. At the end of the day, these are not just insurance distributors, they are embedded in how risk is transferred, structured, priced, and managed across the global economy. And as long as risk remains complex, high stakes, and increasingly interconnected, the role of the broker is far more likely to evolve than disappear. If you enjoyed this episode, drop a comment or vote in the episode poll. And be sure to read my new Substack with a podcast recap. For real-time updates, follow me on X at Invest091. Join me next month when I'll dive into Align Technology, ticker symbol ALGN. Until then, keep your investments smart.